Hi and welcome to this video explaining how to account for cryptocurrencies in line with IFRS. Hot issue, but not very well guided. I am Sylvia of IFRS Box, the place to be if you want to understand and apply IFRS easily. I have created the IFRS Kit, a comprehensive IFRS learning platform for you, plus lots of free IFRS materials, so you're welcome to check them out at ifrsbox.com. Before we start with accounting, let's explain what the cryptocurrency is in its substance. It is a digital currency designed to function as a medium of exchange. And I put a currency in double quotes on purpose because cryptocurrency does not have the characteristics of regular currencies as described in IAS 32. The main characteristics of cryptocurrency are that it is decentralized, so not issued by any central bank or other official institution, so there is no legal tender as with other currencies. It is recorded on a distributed ledger called blockchain. And indeed, cryptocurrency does not have any coins or banknotes. Instead, it is just a list of electronic transactions or payments organized into blocks. Blocks are connected with each other and they create a chain, hence the name blockchain. Each block contains transactions and a sort of digital signature or proof of work. So cryptography is used to maintain security, trust, and prevent fraud. And this proof of work is created by the computer solving cryptographical puzzle and is also sometimes called a hash. And that is very quick explanation. And if you just want to buy cryptocurrency like Bitcoin, Ripple, Ethereum, or Litecoin, you don't necessarily need to know how this precisely works. But I will explain a bit more about that later in this video. For now, let's explain why cryptocurrency is not a currency. Yes, it sometimes can be used in exchange for some goods and services if the counterparty accepts it. But it is not so widely accepted as euros, dollars, rupees, pound, yens, or other currencies. It is not used as a monetary unit in pricing goods or services because the pricing is usually done in normal currency and then pricing in cryptocurrency is derived from regular currencies. It is not used as a measurement basis in the financial statements, so usually do them in your own currency. And all of this is against the definition of currency in IAS 32. And moreover, there is no contract, no legal tender, no counterparty. You're only dealing with a program that you and other participants trust. As a result, cryptocurrency is not classified as a financial instrument because it fails its definition. And this is also supported by the IFRS decision from June 2019. So, if it is not a financial instrument, what is it then and how to account for it? Well, let's firstly look at the accounting by the holders or those who buy cryptocurrency either to hold it or trade with it, but are not involved in mining it. According to IFRS decision of June 2019, cryptocurrency is an intangible asset because it is an identifiable non-monetary asset without physical substance. That is all true because it meets the definition of an asset and it is separable. You can sell it to someone else. As a result, accounting for cryptocurrency by holders depends on the purpose of holding it. So if it is held for trading, for example, by cryptocurrency dealers or brokers, then they should apply IAS 2 inventories, and more specifically the paragraph 3b guiding the commodity brokers. So they should treat cryptocurrency as current asset and measure it at fair value less cost to sell. If the cryptocurrency is held for other purposes, for example, for capital appreciation, storage of value or other, then the holder should apply IAS 38 intangible assets. And here, the holder has a choice to use revaluation or cost model for the subsequent measurement. And both of these models have their advantages and drawbacks, especially for cryptocurrency. and I write more about it on my website, ifrsbox.com. Anyway, most cryptocurrencies have indefinite useful life. And as a result, you do not charge any amortization. Just be careful about impairment. Now, let's talk about accounting for cryptocurrency by the miners or entities involved in creating and forming cryptocurrency. Unfortunately, IFRS said nothing about miners, so we need to apply currently existing IFRS to this situation. Many people think that miners mine or do some sort of activity similar to mining or extracting of mineral resources. And therefore, they should apply IFRS 6 exploration for and evaluation of mineral resources. But this is a big no. Miners are not mining in this sense. So what are they doing? Well, you should understand the process of cryptocurrencies a little bit, at least, to decide how to account for it. So let me try explain it simply and clearly without loads of technicalities. You have other videos on that topic on the net. There are more types of functioning, so let me just focus on one of them. So there are people who make transactions in cryptocurrencies together. And all these transactions are recorded in a big ledger. For example, one person pays to another person, and this transaction is recorded here. No physical money moves, just the record is made. Similarly, many other people perform the transactions, and these transactions are recorded in that ledger as well. And to make everything safe, reliable, and free of fraud, sort of digital signature or proof of work is involved here. I said previously that the ledger is decentralized. Simply speaking, everyone has a copy of that ledger. Now, as the ledger is huge, it is split to blocks, and these blocks create a chain because they are tightened together using the specific methodology, and hence the name blockchain. Well, how to make sure that everybody has the same copy, and how to prevent fraudulent transactions. And this is where miners or validators do their job. They are listening to transactions broadcasted by the participants, validate them by the cryptography, and include them in the blocks. For this, they receive some transaction fees. Also, they create blocks, verify them, and update the ledger or the blockchain. And this involves a lot of computing and trying to solve mathematical puzzle to guess the unique hash or code or proof of work that can validate the block. And for this, they get the block reward. So let's try to come up with the appropriate accounting for these rewards. And let's start with the block reward. And to create valid block, the miner needs to literally guess the hash or the proof of work. It is not possible to derive it, just to guess it by trying and failing, and one out of many attempts is successful. And it requires a lot of computational strength and resources. In fact, from what I have just explained about functioning, you see that the miner is not mining, but providing a service. So we may think that IFRS 15, revenue from contracts with customers, applies here to account for the block reward. But the block reward is paid by the system algorithm. So once the miner makes a successful guess and has the correct hash, validates the block, the system includes some amount of cryptocurrency into that block that belongs to the miner out of thin air. This is not paid by anybody. In fact, the new cryptocurrency units have just been created. Well, this doesn't go on infinitely, but let's leave money supply out for now. There is no customer or no contract at all. You might argue that a customer is a network and the contract is implied here, but there is a problem to enforce it. So I would say that IFRS 15 does not apply here. Instead, when there's a lack of other guidance, we need to apply the conceptual framework for financial reporting and include this block reward as income in profit or loss when it arises. The journal entry is something like debit intangible assets, because we explained that cryptocurrency is an intangible asset. Well, or sometimes you debit inventories if the miner happens to trade with cryptocurrencies as well. and we credit income in profit or loss. How about the transaction fees? As I have already mentioned, they are earned for including the transaction into the block and validating it. So they are related to the specific individual transaction, not to the block as a whole. They are paid by the originator of the transaction, not by the system algorithm as the block reward. So here we can clearly identify the customer. It is the originator of the transaction or the person who makes that transaction. The contract here is implied, so it is understood that the transaction will not happen without paying that fee. Therefore, we can conclude that IFRS 15 applies here, and you can include the revenue in profit or loss as the miner becomes entitled to that fee. The journal entry is to debit intangible assets or inventories, well, depending on the purpose of holding the cryptocurrency, and credit revenue in profit or loss. What about the expenses incurred by the miners? Well, miners arrive at proof of work by using lots of computational power, so they incur high expenses for computers, graphic cards, electricity, and other. They literally compete with other miners to solve an algorithm first before other miners, so they have both unsuccessful and successful attempts. And therefore, there is an element of a lottery. It is difficult, if not impossible, to separate expenses for successful attempt from unsuccessful attempts. Moreover, miners provide services. They do not develop any intangible asset. Exactly due to failing the criteria to capitalize internal development or not be able to measure the costs reliably. Therefore, the expenses are not capitalized as internally developed intangible assets, but they should be included in profit or loss. This is the view from the current perspective and status of IFRS standards. However, new crypto assets are emerging, such as various tokens, and you should use a different method for accounting them. And indeed, some official guidance would be appropriate, as it is quite possible that the complexity will increase. Well, one last remark. If you are a miner in a pool of miners not acting as a single miner, watch out IFRS 11 joint arrangement. So that was my attempt to bring some clarity into accounting for cryptocurrencies. I hope you liked it, and if you need to learn more, you are welcome to check ifrsdocs.com. Thanks for watching.